Here's a new weekly outlook for this week. And this week, the market is going to be reacting to credibility and stability risk in rates, currencies, and geopolitics. And that is why when the market closed out last week and in the beginning of this week, the anticipation is that we are going to see strength in some assets, hesitation in others, and very selective follow through. So here, in terms of overall market structure, even on the technical side, we will see that nothing is really broken here just yet, but several systems are currently under stress, and that changes how the market is going to behave, especially when there are major central banks that will be reporting their interest rates. Starting off, we have the instability that we're dealing with globally, which traces back to Japan. It took roughly $280 million in trading to trigger a sharp dislocation across the Japanese government bond market, wiping out tens of billions in value across the curve. This kind of reaction doesn't happen in a deep, healthy market. So fundamentally, this reflects that Japan is adjusting to persistent inflation, rising fiscal concerns ahead of February 8th elections, and years of suppressed volatility that is finally unwinding. From a market sentiment perspective, this matters because Japan is no longer an isolated market. It is now being treated like a global transmission channel. And when long-dated bonds in a major developed economy like Japan lose stability, then institutions will reassess their forex exposure, their equity risk, and any potential cross-asset correlations. Very particularly, they talk about USDJPY, and that is exactly the pair that we are going to be following this week very closely as well, where USDJPY pushed towards the 159-160 zone and then reversed very aggressively. And that reversal wasn't based off of any sort of key price level or any sort of technical setup. It was purely behavioral because the Japanese officials have also warned very publicly against speculative and abnormal moves. The finance ministry declined to comment on the intervention. Then the markets found out that the New York Fed had contacted financial institutions about the yen exchange rates. So whether the intervention actually occurred is irrelevant because what matters now is that the intervention risk is now being priced into the market. From a sentiment standpoint, the trend continuation on this pair becomes unreliable, breakouts fail more frequently, and positioning unwinds faster than traders will expect. So USDJPY will now stop behaving like the clean trend market that we have been trading for the last couple of weeks and start behaving like a crowded trade with a tripwire. That is also why this week, studying the pure price action and the structure is going to matter a lot more than just using indicators, especially in a volatile environment like this. This also impacts the US equities, but the volatility is going to impact US30 very differently than it would with NAS100. The US30 or the Dow benefits from the cash flow stability, industrial exposure, and relative defensiveness. So as long as global volatility doesn't accelerate significantly, then US30 can remain stable, but it will not be immune if the bond stress resurfaces. And we do see signals of that from a price action perspective, which we will take a look at in just a little bit. But on the other hand, the NASDAQ is far more sensitive. It's exposed to rate volatility, global risk sentiment, and duration risk. So it doesn't need panic for a massive correction. Uncertainty alone will be enough for that. So this is not the environment to treat all equities the same here. We also see oil that is climbing up to record levels, but not because the demand has suddenly improved, but because risk premium is being repriced. On a technical side, real quick, if we take a look at the chart, we see that oil has been sitting in a massive consolidation for weeks, and now it's finally starting to break out of that massive consolidation here. And so that's exactly what this article is pretty much talking about here, where the renewed US narrative towards Iran, military asset movements, and unresolved Ukraine tensions and extreme winter weather conditions in the US are all contributing to this. So this is not a structural bull market in oil, it's simply headline-driven market, which carries on that sentiment that we have been seeing the last couple of weeks, especially since the beginning of the year. And when energy risk rises, then it feeds directly into inflation expectations, currencies, and equity positioning. So that is why we are going to be following this news very carefully too. Before we move on to the economic calendar, we also see that gold is rallying, but it's because it is now being used as insurance, not basically as a fear parking asset. So it's not rallying because the markets are panicking, it's rallying because the bond markets are sensitive, currency credibility is being questioned, and geopolitical uncertainty has a higher floor now. So this is a classic investor allocation behavior and not speculation behavior. And that distinction is going to matter a lot when we move on to the price action side. So let's take a look at the economic calendar before we move on to the technical side. We start off quite easy this week with the durable goods orders that are going to be coming out from the US tomorrow. And then we have some red folders in Asian session on Tuesday with CPI data coming out from Australia. If you're trading the Aussie dollar, that's what you want to pay attention to. But all eyes are going to be on Wednesday with interest rates coming out from Canada and also from the US. We're expecting that the interest rates will be maintained in the US. So what matters more is going to be the tone and the press conference, as always. And then Thursday, we have the unemployment claims. And Friday, we end off with PPI data coming out and then GDP from Canada. Let's start off with US30 here. On the daily time frame, we see a clear bullish structure here, clear higher highs and higher lows since the April base, and no confirmed lower low formation here. Overall, the primary trend remains bullish, but what we start to see here in the beginning of this year is compression near highs. We see those upper wick, which are showing the profit taking and not aggressive selling here. Any pullbacks here are still very shallow and just corrective. So this is not necessarily any sort of distribution or massive sellers that are entering the market. This is simply acceptance at those higher prices and now waiting for those fundamentals. So as long as those prior higher lows will hold, then the overall trend remains intact and we're going to continue buying any of these low formations. What I'm going to mark off is that previous low right here, which is going to be 48, let's just say 500 area into that support. And then we had a gap down today, which the market has filled in, but we are going to be targeting those previous highs first, which is 49,300. And then if price can continue pushing bullish, then our target here is going to be that 49,600 area. So first target for any buys, that 49,300, then another 300 point move to the upside, drop down to the lower time frames, and this is where you start to find your intraday entries for any scalps or even day trade opportunities. So as price is pushing back down, we're currently sitting in the middle of the range. What I want to see is if price can hold on to a strong support right into these areas and then continue pushing back up bullish. I wouldn't look for a trade here because we're very close to the support area. So I'd rather wait for price to hold on to a clear support, consolidate, or break the previous area and then give me a resistance right below 48,500. But if we can hold on to a support here and continue pushing back up, then we have those clean buys to the upside up to 49,600 at the bare minimum. NAS100 is quite similar in terms of structure. So we have that strong bullish leg from April here as well, which transitioned into this range-bound consolidation from about October or even early November area. We see those massive long wicks on both ends and the alternating bullish and bearish closes. So overall, this is a decision zone, not a breakout environment. What NASDAQ is waiting for here is clarity on rates and the risk sentiment. So it will react faster than US30 to any volatility shock, especially with the interest rates that will be released on Wednesday. So we're going to mark off the support here. This also gap down, made a nice bottom wick, and then flip back up bullish. I am targeting these stronger liquidity zones here at that 25,000 mark right down here. Every time price exits above that area, we get a nice bullish momentum to come back right into those previous highs at around 25,800. This is also kind of in the near mid-range here. So drop down to lower time frames. We still have a little bit of gap that the market has to come back and fill. So we have this exact consolidation right here. If price can hold on to a resistance and push back down, then we have those clean sells to come back into that 40 or 25,000 mark. If price breaks above it, this is a no trade zone. And then if price breaks above the 25,800, then we're looking for buys to the upside. You can also use those higher time frame levels to kind of figure out what is the direction and make sure that you're actually exiting out of that consolidation before looking for any swing trade opportunities. Other than that, I think we have great opportunities for scalps and even day trades. We just have to be a little bit more careful when it comes to any swing trade opportunities. We are going to come back to GBP USD. So let's just start with Euro USD here first. And then here we see that we've had a nice, again, bullish momentum from 2025 here. Ended up in a consolidation right here. But within that consolidation, you have those higher high and higher low formations. So we have this entire bullish structure to the upside. Price holds onto a major support area right here. And then you have those higher low formations to the upside after testing the structure. We got a massive push up, the first close out of this consolidation right there. A gap up with today's candle, which rejected right into those previous highs. So if we're looking for sells, we're going to look for sells to come right back down into about this 1.15 area. So let's mark off that support. Or 1.158. That's the major support area. The resistance that the previous daily candle has broken above and closed, which is that 1.18. And then the current rejection that we are seeing at 1.19. Drop down to the lower time frames. On the 4-hour time frame, we've got a first bearish candle closure, a little bit of a gap that the market still has to fill in. So if price breaks below 1.18, then you target down here to 1.173. Continuation down close to that 1.166 or 1.165, and then finally down to about 1.158 area. If price continues breaking above that 1.19 area after making a bottom wick right here at 1.18, then we are going to look for support formations here on the 1-hour and the 4-hour time frame. Look for those buys to the upside, and then you hop up to the weekly or the daily time frame and you look at where's the next resistance, which is the key level right here at around 1.12 area, and then ultimately up into 1.225 area. So here you have good opportunities setting up for any sort of swing trade, mostly to the upside, but this is going to be most affected by any sort of USD stability rather than the euro strength here. And that's because the Euro USD right now is acting like a pressure valve on the US dollar, rather than any sort of euro news that will be really moving this pair. Then we have GBP USD, which is quite similar. If I zoom out, we've got a nice bullish pressure to the upside, but same thing here. We start to consolidate out, tap out into these previous high levels. So overall, clear bullish sequence, strong impulsive legs, shallow pullbacks, coming right back down into some liquidity areas here. So this is more like a trend continuation behavior, not a massive or an aggressive reversal move. So same thing here. We've had first candle closure above this consolidation area, which is that previous high at about 1.362 area. And then we have our next high that price is pretty much approaching after it makes a bottom wick. Again, it has gapped up. So make a bottom wick and then flip back up bullish, continue back up to about 1.379 area. But if price comes right back down, then we're looking for sells to come back into about 1.334 area. Drop down to the intraday levels. We've already got a 4-hour bearish candle closures. If the next one makes a bottom wick and pushes back down, then all of these are sells. Then you target these minor levels here for your partials or your take profit levels, and then you look for your scaling opportunities. But if price holds onto a support here and then pushes back up bullish, then we have this clean range to the upside. And this range is for about 167 pips here. So we have really good potential or opportunities that are setting up. Let's come over to GBP, JPY. So strong uptrend here as well. And then price taps out at 214. We see those corrective moves, and we have seen that in the past as well, where price pulls back down into this current support area and then pushes right back up. So right now we don't have clarity on clean sells here just yet, but those clean sells will make sense below that 210.5 area. We're seeing a lot more volatility at these highs instead. And then when you drop down to the 4-hour time frame, then you see all this consolidation. So no trade range here. If price pushes down further, holds onto a support here and then pushes back up, then we have those buy opportunities to the upside. You've got clean buys to the upside for about 262 pips. If price rejects this and then holds onto a resistance, then we're looking for sells to come back down for about 155 pips at the bare minimum to target the previous resistance here. So same thing here, you have really good opportunities that are setting up when it comes to the intraday levels. And then for swing trades, price is sitting at pretty key levels for a lot of the pairs, so just be very careful. With USDJPY, we already went over that article, but just to go over it one more time, we see a massive bullish structure to the upside, and then we saw that recent bearish candle that really disrupts the short-term momentum that we had. And then today, when the market opened up, again, it gapped down and it's pushing back down. But we are pretty much sitting in this overall zone of support here too. So no clear indication of sells just yet, unless price can break below that 154.2 area, hold on to a resistance, and then continue pushing down. And then ultimately, we are targeting this gap fill down here. If that happens, first you're going for about 120 pips, continuation down for about 258 pips, and then 475. And if we do end up getting that gap fill, then we're going for about 600 pips to the downside. But right now you're sitting in this key zone. So just wait for price to either hold on to a support here or break below that 154.2, hold on to a resistance, and then continue pushing back down bearish. We still have a little bit of a gap here that the market has to fill in as well. Then before marking off the highs right there, we're going to mark off these first resistance levels that the market has to break past, which is going to be that 157.7 level. And then if price can break past that, then you have 159 to the upside. Drop down to the lower time frames, and then you can map out these key levels right here, which would be your take profit levels if you're looking for buy opportunities. And then let's end off with gold. So with USDJPY, again, your direction is less reliable at the moment unless structure itself will give you that direction after breaking those daily and the weekly levels. Now looking at gold, that is clearly bullish, consistent higher highs and higher low formations, all the buy the dip sentiments, and that's exactly what we have been doing as well. And this is no immediate rejection here just yet. As you can see, we do have some gaps that the market still has to fill in. We had a gap up today as well. So gold right now is behaving more like a capital protection and not any sort of speculative moves. So as long as the structure holds here, the pullbacks still remain corrective, and we're just going to continue buying those dips. We were targeting that 5,000 mark, which has obviously been hit. So the next target that we're going to go with is going to be around, based off of what Goldman and JP Morgan have said in their analysis, and even last year, is around 5,000, and after that it was around 5,500. So we're targeting somewhere up top here if price can continue pushing. But we do need some corrective moves here, which the market will give you after a massive leg up. There will be some corrective moves, and so that's what we're expecting here. So we're not going to mark off a resistance here just yet, but what I am going to do is mark off some of the key levels after we drop down to the lower time frames. So here on the 4-hour time frame, that's the last support area that was formed. We want to see if price can come back and revisit into, let's say, we'll just call it 49.20. If it can come back and revisit that with that gap fill, maybe a push down a little bit more and then continue pushing back up bullish. If price breaks below, let's say 4,900 mark, then we are targeting 4,800. And then ultimately this gap fill into this around 4,600 level. Right now, gold is still very much just buy the dip. So every time we see a corrective move and we see those clear support formations, then we're just going to continue buying to the upside. So that's pretty much it. So heading into this week, the framework that we are going to be following within Sharma FX is that Japan remains the volatility trigger. We're going to continue following the news and developments there. USDJPY is no longer a trend-only pair. We just went over the technical setups for that too. US30 is more stable, and NAS100 is going to be a lot more sensitive this week. Gold remains more like an insurance asset rather than just chasing the highs here. And overall, Forex trends will be favoring the structure over any sort of prediction that we will be seeing throughout the week. So this is the type of environment where having a repeatable weekly process will matter, and knowing what to watch, what to ignore, and where price actually needs to prove itself. I am teaching a 12-week trading accelerator. So the Applications are open for that on shermanfx.com website. If you're interested, we are teaching you how to build your own data-driven strategy. And for traders who want this context laid out clearly before the week starts, we also have a free weekly market intelligence brief that covers the key risk and the levels that we will be tracking. And again, you can sign up for that either with the link below or at shermanfx.com. So make sure that you guys are following proper risk management, you're following your price action, you're trading your plan, respecting the structure. And I will see you guys for the next weekly outlook.